What time is it, Phil?
It's 2 p.m. Pacific. Time for Mortgage Minute with Art Alvarez.
Let's dive into today. Just those of you who are watching live, please do me a favor. If you have questions, please put them in the comments. I'll feed them back into Art. And if you are watching this recorded, please just also put them in the comments, whether YouTube or Facebook, and Art will get back with you. Also, before I turn it over, I want to remind you that Art every day puts out a video, and it's on YouTube and Facebook, that gives you the update of what the rates are right now. So if you're thinking, hey, should I get involved in the market, check out Art's it's a mortgage watch, and that's every day he gives us the update. So Art, great job, and I'll step out now and turn it over to you.
Okay, thanks, Jeff. Hello, everyone. Art Alvarez at Mortgage Works, where we have the answers and they're on the house. As you know, what we like to do is start the show with giving you a little bit of a interest rate and bond market update. So we'll jump right into that. There's our rate grid as of right now. And it's interesting because rates are still hanging in there. The bond yields have been rising up a little bit since mid-December when we got into the high threes. We're now hovering around 4%. But you can see there that, conforming Fannie Mae, Freddie Mac loans are still around the mid sixes. We're still able to originate FHA and VA loans in the high fives, around 5 3/4. And again, this is a little bit of an increase over where we were in the second, third week of December when conforming loans, we actually got pretty close to about a 6.1 level, and FHA VA was around 5.5. So there has been that little bit, about a 0.25% increase in interest rates since mid-December. And Jeff's going to pull up the 10-year bond yield chart so you can see how that move has occurred. And you can see right there, 4.02. That's where the yield is right now. And you can see a couple of dips there. And actually, if you go back further, which we don't have, but if you go back to, again, mid to late December, the 10-year bond yield actually got down around 375, 380. So we have had a little bit of an increase since then. As to this week, what's going on with the bond market, what's affecting mortgage rates? Well, this week, in terms of data points, there hasn't been a lot. It's mostly all about the CPI, that's the Consumer Price Index, and the PPI, that's the Producer Price Index, also known as CPI is a retail inflation number. PPI is referred to as the wholesale inflation number. And CPI actually came out today, and it was, as the media, their new favorite term as it relates to economic data points, the CPI number today was hot, meaning it was up a little bit. Year over year, the CPI is at 3.4, just released today. Over the previous last month, that being November, it was 3.1. So a little bit of an uptick, which is part of the reason that 10-year bond yield is where it's at that 4.02. Tomorrow, the PPI, the Producer Price Index, will come out. So we'll see how that plays out. If there's a little bit of an uptick with that as well, then I think these bond yields in a little over 4 is probably going to remain at that level. It might even tick up a little bit more. So we'll see what happens. I wanted to shift gears a little bit, and I've got on the screen here a couple of bullet points as to forecasts for mortgage rates for 2024. And I found them kind of interesting because, for example, Redfin is on record now of saying mortgage rates to fall to 6.6 by the end of 2024. That implies that from their perspective, mortgage rates currently are higher than 6.6. Well, if you go to our website, right there on the rate grid on the homepage, you'll see we're already there. So it's interesting that they're saying rates are going to fall to 6.6 when we can offer that or a little bit better right now. Emphasis Digital Risk, that's a company that provides basically platforms for the mortgage and lending industry. They also are predicting rates to stay in the mid-6 range for 2024. And then also I had to throw in here a quote from the NAR, that's the National Association of Realtors chief economist, who is quoted as saying recently, a marked turn can be expected. That's a turn in home buying activity can be expected as mortgage rates have plunged in recent weeks. Well, I have a little bit of an issue with the term plunge. Yes, we had a bit of an improvement, since October, when mortgage rates, well, the media says that they were at 8%. We never got that high. We got into the low sevens, about 7.25. So now that we're at 6.5, 6 5/8, 6 3/8, that's being described as a plunge in mortgage rates. Well, I would not agree with that terminology. We've had some nice improvement. We're simply back at the interest rate levels that we saw in May and June. And as I pointed out in the last couple of shows, back then, mid sixes was not considered great, was not helping the mortgage market and the home buying market a whole lot. But I think what's going on here is, as we have at the bottom of this file or on this slide, where I've got on rates higher for longer. I think people are realizing we're probably going to be at these levels for an extended period of time. You should not be waiting for 2s and 3s again. That's not going to happen probably in our lifetime. That was unusual. So I want you to realize, first of all, we're already at the levels that these predictions for the end of 24 are. We are already at those levels, and hopefully we'll stay there if the bond market remains stable. So there's your update on the mortgage rates and the bond market. So with that, I want to go to another topic. And this was actually an article I saw on the financial page that really caught my attention. And you can see there, the article, the headline of the article was, "People are sharing how tough it is to buy a house in today's market. And it's wild how difficult it's been." And that was from BuzzFeed last Sunday, January 7th, 2024. So I was reading through some of the testimonials of you, if you will, of some of these home buyers where they described their experience in purchasing a home. And this one caught my attention. And it was quite a bit longer than what I have on the screen here. But the bottom line of this person's commentary was, however, even with a 20% down payment and salaries that equated almost $200,000, we could only afford a bungalow. Breaking into the market is so difficult. Well, that really caught my attention because I was thinking, if you're making $200,000, it shouldn't be that hard, even at these interest rate levels, to get into the market and buy a home. So let's take a closer look at this scenario. First of all, per CoreLogic, now CoreLogic is a data analytics company associated with the mortgage, real estate, and insurance industries. And in October of 23, CoreLogic published something that indicated that the rent-to-income ratio has hit 40%. Now, that's a national number, but the point of it is rents as a percentage of the typical renter's income has now hit 40% of their income. That's an all-time high. And in my mind, and we've all heard that rents have gone up quite a bit. I mean, crazy high in a lot of markets. So if you're paying rent that's 40% of your income, and particularly if you're making good income, that begs the question, why aren't you able to afford a home? So let me give you some assumptions to think about, and then I'm going to show you some numbers that I think you'll find pretty interesting. Let's assume the interest rate for a mortgage is 6.5% for conforming loan. And let's say you have a 20% down payment, although I'll keep reiterating, you don't need 20% to buy a home. If you're a first-time home buyer, 3%. FHA loan, where you don't have to be a first-time home buyer, 3.5%. You don't need 20%, although in this case, the person on the BuzzFeed article said they had a 20% down payment, so I'm going to use that. And to be a little more conservative, I'm going to assume $180,000 annual income. That's $15,000 a month. So a little bit below that $200,000 that this person had commented on in the BuzzFeed article. Well, let's look at these numbers in terms of a ratio of income to your housing expense. At a 40% housing ratio, which I would argue is the same as rent to income ratio, that would mean $6,000 a month in a housing expense. Now, when you're getting a mortgage, that housing expense would include principal and interest, property taxes, insurance, and if applicable, HOA dues. Well, with a $6,000 housing expense, and if you have a 20% down payment, guess what? That equates to being able to purchase a home for almost $1 million, $950,000. But let's be more conservative. Let's assume you don't want your housing expense, your housing ratio to be more than 36% of your income. Well, that's $5,400 a month. And with a 20% down payment, that equates to being able to buy a home for $850,000. And let's be even more conservative. Let's say you don't want your housing ratio to be more than 33%, which I run into that a lot. People who do have good income, say $15,000 a month, they'll tell me, yeah, we know we can afford $6,000 a month housing expense, but we don't want to. We don't want to live for a mortgage payment. So if we assume a 33% housing ratio, that still equates to a $4,950 a month housing expense for principal and interest, taxes, insurance, and HOA dues, if applicable. That translates to a $780,000 home. So the point of all this is, in a lot of markets, now maybe LA, Orange County here in Southern California, price range in the 780 to 950. In a lot of these cities here in Southern California, that would be considered a first-time buyer home, a starter home. But in a lot of markets nationally, you can buy quite a bit of house for these price ranges in the 780 to 950 range. So I'm kind of scratching my head a little bit when somebody tells me if they've got that kind of income and if they do have a 20% down payment, that purchasing a home has been so much of a challenge. It really shouldn't be. Conclusions, I would suggest record high rents suggest that homeownership is not out of reach. If you're paying rent of 35-40% of your income, and if you have good income like this person does, you should not feel like you can't buy a home. The other conclusion is, I think home ownership challenges are more associated with high consumer student loan debt loads, not mortgage rates. I think mortgage rates are sort of, getting a bad rap that they're the reason people can't buy a home. Well, guess what, folks? A lot of the inquiries I get to pre-qualify people, it's not the actual housing expense that's causing them problems and getting qualified based on their income. It's more about their other debt load, particularly credit cards, particularly, frankly, car loans. It's amazing what people are willing to pay monthly for a car. Those are the kind of things that I see more often are preventing people from being able to afford buying a home than what the actual mortgage rate is. And the other thing to think about is if you are willing to incur a mortgage housing expense that is comparable to the rent levels that we're talking about, the mortgage expense gives you additional features, benefits actually, that paying rent does not, such as appreciation in the home. You're going to build equity. You're going to have tax benefits. And another thing that a lot of folks don't realize is if you get a mortgage for $5,400 a month rather than paying rent for $5,400 a month, then you're going to be able to get some credit rating benefits because that mortgage payment is going to be reported to the bureaus. That's going to help build your credit history and your credit scores. A few programs ago, we did talk about if you are a renter, talk to your landlord, find out if they're involved in reporting your rent payments to the credit bureaus. That's another way to build your credit rating. But the reality is most renters are not doing that. So if you're able to afford rents at these levels, investigate, talk to somebody like us. We can help you get that home, get that mortgage, and then that's going to help build your credit rating and your credit score even more. So I wanted to basically share this with you to make you realize or help you realize that home ownership really truly is not as out of reach as a lot of folks think that it is, particularly if you are paying rent at these kind of levels. So there you have it. I hope that's going to be helpful to you if you are contemplating buying a home. It really is possible, and we can help with that. So with that, I'm going to bring Jeff back on because we have a couple of interesting questions this week that I want to cover.
Hey, Art. Yeah, we've got a couple of questions I think that are really interesting. One is about gift funds for down payment. And the person said, hey, I'm planning on buying a home, and my parents would like to help me with the down payment, but they're concerned about having to report this to the IRS and paying a gift tax. Is that a valid concern? Now, I just want to say, Art, I know you're not a tax consultant and you're not an attorney, so you want to make sure to check that out. But you've probably dealt with this many, many times. So what's your thought on that?
I have. And first of all, you're right, Jeff. My disclaimer is, everyone, I'm not an accountant. I'm not a CPA. I'm not a tax attorney. So my disclaimer always has to be, please check with your tax advisor regarding the information I'm going to give you, because I'm not in a position to advise you officially, if you will, with these kind of matters. But what I know is a couple of things. First of all, and this is a question that we do get quite often when I'm dealing with a prospective borrower, home buyer, who is going to be looking at getting gift funds, typically from a relative. There is often a concern about, is there going to be a tax consequence, a tax implication? What I do know is, for example, in 2023, the gift tax, or I'm sorry, the exemption for providing a gift to a person like a relative, the exemption amount is $17,000 in 2023. So the idea is, if you were going to be giving a gift to a relative like a son or a daughter to purchase a home, if you're providing gift funds that are within that $17,000 limit, nothing to worry about. It's exempt. You don't have to worry about reporting that to the IRS. Now, if you're giving a gift of more than that, then you're above the exemption. And so the portion above that exemption would have to be reported. There's actually a form, it's called a Form 709, that would be used for that purpose. However, even when you do that, it's highly unlikely you're going to incur any kind of gift tax. Why? Because each person in the US has a lifetime gift exemption that is almost $13 million. In fact, in 2023, it's about 12.92 million. So the idea here is that if you are going to give a gift to a relative, if it's under 17,000, no consequence at all. If it's over 17,000, you should be reporting it on a Form 709. But even then, you aren't likely going to be paying any tax. Why? Because that amount over this annual exemption, again, is 2023, 17,000. That amount over that exemption limit simply is deducted from your lifetime exemption. So all you're doing is drawing down on that lifetime exemption. And as a consequence, you're still not likely to incur any tax consequence. So that's important to know. And I hope will help you realize that providing gift to a family member to buy a home is actually a good thing to do. But let me also real quick touch on, when you're going to provide a gift to a family member, there is a process for that. We have typically, for a mortgage situation, we're going to fill out a form, what we call a gift letter form. It's going to be signed both by the donor and by the borrower. It's going to identify the relationship between the donor and the borrower. And in most loan programs, that relationship has to be a family type relationship. There are a couple of exceptions to that. And we do have to track that gift money flowing from the donor to the borrower. And in the gift letter itself, it specifically says, this is gift for the purpose of buying a home, and no repayment is expected or required. Now, that doesn't remove the fact that my experience is, in a lot of cases, family members are maybe not that generous, in the sense that oftentimes, I think, after they get the gift and close on the home, there is probably some sort of agreement to get the money back to the donor, to the parents, what have you. But the point is, it's not expected. It's not required. That's what you have to represent in your mortgage application. And if you do that, and we're able to track the money from the donor to the borrower, then it's going to be fine. We do have to also, by the way, verify that the donor has the ability to provide the gift. So we do have to get like an account statement from the donor to show that they already have that gift amount in their bank account, ready to go to give to the prospective borrower. So we have to verify it to that extent. So good question. I hope that help you all realize that providing a gift to a family member is really, truly a good thing to do. And you're not going to have to worry about Uncle Sam too much.
Yeah, I think that's a great example of how you can help a family member out and not incur any tax ramifications. I didn't realize the gift tax was almost $13 million. I guess I should have asked more from my parents when I was younger, so that they didn't have to worry about tax ramifications. They're giving their son Jeff some money, but
right.
another story. All right,
Yeah.
so we have a second question. I know this is from one of your, hey, it's 2024, and I just looked, and there's a dartboard up with his face on it. No, I'm just kidding. Dave Ramsey says HELOCs are stupid. He said, on your program, you often talk about the benefits of HELOCs, but Dave Ramsey calls them a stupid housing trend. Art, what's your response to that?
Well, yeah, that's a good question. I've talked about Dave Ramsey before and some of the advice he gives. And look, I'm not anti Dave Ramsey. First thing I will tell you, I fully support his overall message. Dave's message is to get rid of debt, and I fully support that. In most cases, and I see it every day, a lot of families, a lot of households just carry too much debt, and the wrong kind of debt, particularly credit card debt in particular, and then student debt, which doesn't have huge, really high interest rates, but as opposed to credit cards, where the average interest rate, at least as of last year, was 21%. It's probably even higher now. So I fully support Dave's overall message that you need to reduce debt and get to a point of being debt free. Fully support that. Dave also promotes strongly that you need to have an emergency fund of 3 to 6 months of your income. Again, I fully support that. That is a very good objective and something that all families, all households should strive to do. So I want to make it clear that I fully support his overall message. But that being said, I think his tendency to, with his, I would call it a tough love approach, to tell a homeowner who has a lot of equity that getting a HELOC is stupid, I think that's a little strong. And I do want to push back on that a little bit. And Dave's concern about that, frankly, it has to do with the fact that you're using your home equity and you're leveraging that in his mind up to the hilt, and that you're burning up your equity and you're doing that to incur more debt because you're using the HELOC. Yes and no on that. So that, and then the other thing that I've seen in both a written article about his comments about HELOCs being stupid, and I actually saw his YouTube video from about a year ago where he goes into this in more detail. One of the things he said was that a HELOC lender can basically just decide to charge you an interest rate of whatever they want. Well, guess what? That's just not true. In fact, if I wanted to take Dave's same approach, tough love approach, in terms of, a strong word would be, he's a liar. I won't go that far, although I just said it. I'll certainly call it misinformation. HELOCs are not a loan instrument where a lender can just willy-nilly, subjectively just decide one day and each month what they're going to charge you in an interest rate. It just doesn't work that way. HELOCs are highly regulated, like any mortgage loan program. You are going to get a HELOC agreement, and the HELOC agreement is going to spell out in detail what kind of interest rate you're going to get and what it's based on. And with most HELOCs, they are based specifically on the U.S. prime rate. That is a rate published basically daily, and it's an objective, what we call index, because a HELOC is a variable rate loan, which is his other concern, that you're not only using up your equity, you're getting yourself more leverage with debt, and you're doing it with a variable rate loan that could skyrocket to 18%, which, by the way, is typically the cap on a HELOC. But of course, we haven't seen 18% rates since, guess what? When I got in the mortgage business in January of 1982. That's not to say it couldn't happen, but the point is that that's his other concern. My take is a little bit different. Well, the other thing that he's worried about is, let's say you take out a HELOC and then and maybe you don't have a balance on it, but then you lose your job. Well, then you're drawing on the HELOC basically to live on. So in his mind, you lose your job, and then what you're going to do is borrow more money, go into more debt because you lost your job. Well, the real world is if you're a homeowner and you don't have a HELOC and you got $30,000 of credit card debt and you lose your job, guess what? What I've seen is that credit card debt's going to go up even more because you're going to use your credit cards to live on until you find another job. So with all that said, the way I would argue you should look at a HELOC, if you're a homeowner, you've got equity, and if you have either a lot of debt, credit card debt in particular, or you need repairs to your home, a HELOC is a very good option and doesn't necessarily violate what Dave's overall message is. In my mind, the way to think about a HELOC is, let's say you are a homeowner and you do have a lot of equity and you don't currently have a HELOC at all, but you have a lot of debt. In fact, I've got one I'm starting now where the homeowner used credit cards, zero interest credit cards, to do a bunch of home improvements to their house. And the interest free period is coming to an end. So they're looking at getting a HELOC to consolidate that. Why does that make sense? Well, first of all, as Dave suggests, you need to pay off that debt. Certainly you do. But in my mind, if you have the equity, get a HELOC. Yes, transfer that credit card debt to the HELOC, and then focus on Dave's strategy to pay off that debt as quickly as possible and maintain discipline to not re-incur that debt with your credit cards. So again, I'm behind Dave 100% on that. In fact, every time I do a HELOC, especially if it's for debt consolidation, particularly credit cards, I always basically counsel my borrowers, look, you have to understand you're using your home equity for this. You need to change your behavior and avoid running up that credit card debt again. So again, I fully agree with Dave on that point. But in my mind, the HELOC is a good transitory step in achieving Dave's overall goals. If you've got 30 grand in credit card debt at 22% interest, and you still have a good credit score, get a HELOC, transfer that debt to the HELOC. You're going to cut your interest rate in half, and you should still attack that debt and pay it off as quick as you can. And in doing so, understand a couple of things. Yes, a HELOC is a variable rate loan. Well, guess what? So is a credit card. In fact, credit cards are tied to the prime rate in most cases, just like a HELOC. But the difference is the interest rate's double or more of what a HELOC rate is. So why wouldn't you transfer it to a HELOC if you have the equity and then attack that HELOC balance as quickly as you can? And the other benefit of doing that is a credit card or credit card debt is not something you can deduct on your tax return. In most cases, again, disclaimer, check with your tax advisor. I'm not an accountant, not a CPA, not a tax attorney. In most cases, you can deduct that HELOC interest on your tax return, a benefit you don't get with that credit card debt. Then the other thing is, if you are able to maintain discipline and not run up your credit card debt after you get the HELOC, and you're able to pay off that HELOC in short order, as quick as you can, then what happens is you've got a HELOC with a zero balance. And with most HELOCs, you can draw against that unused credit for 10 years. So in that respect, I consider that somewhat of an emergency fund that Dave likes to talk about. Yes, it's not money in the bank, it's not a savings account, but you've got it there with no balance. So if you run into another emergency, you have an option to go after that HELOC and draw against it to get some funds. Now he'll argue, wait a minute, you're borrowing money again. Well, true. But in the meantime, if you've been able to transfer the credit card debt to a HELOC and then pay off the HELOC balance so it's zero, at least you have that there in a worst case scenario. In the meantime, follow Dave's other primary strategy, save up as much money as you can, build up a savings of 3 to 6 months of your monthly income. That way, the HELOC then kind of moves into like a secondary worst case emergency fund. Your primary emergency fund would be that savings account. So in my mind, you can use a HELOC as a transitional step to still fulfill the goals that Dave is urging you to fulfill. So that would be my pushback to Dave, why I think HELOCs are not a bad idea in the right circumstances and if you change behavior. And so I disagree. If you want to get a HELOC and if you follow the steps that I just described, you're not stupid. Jeff, back to you.
I just love you. You danced in that arena with Dave very nicely, and it makes total sense. It's like, yeah, there's not this absolute answer, and I think a lot of times, and I've actually gone through Dave's program. It's absolute. Like, this is it. There are no deviations. This is the way you do it. So I like the way you handle that. I just wanted to pull something up and get your opinion on this, or not your opinion, but your information on this, because I was listening to your update of the mortgages yesterday on Mortgage Watch, and I wanted to ask you about the HELOC and the rate, and how long has it remained pretty stable?
Very good question. As I just mentioned, HELOCs generally almost always are based on the prime rate. And again, you can look that up. You can Google that. And the prime rate currently is 8.5%. And the prime rate, unlike a 30-year mortgage rate or a 15-year mortgage rate, FHA, VA, a prime rate directly correlates to the Fed funds rate. So part of the reason the prime rate is now at 8.5, when back in 2020, 2021, it was like, 2.5%, 3%, is because of what the Fed has done over the past 2 years of continually raising the Fed funds rate to fight inflation. So as a consequence, that's why we have the prime rate at 8.5, and with most HELOCs, there's going to be a margin over that prime rate. But the point of all that is the Fed has not raised the Fed funds rate since July of 23. So we are now at about 6 going on to 7 months where HELOC rates have stabilized. They have not gone up anymore at all. And of course, now there's all this optimism that the Fed's going to start lowering the Fed funds rate multiple times this year, which is why, if that bears out, now may be a good time to get a HELOC if you've been on a fence about it, because it looks like the probabilities are, even if you get one at these current rate levels for a HELOC, pretty good chance that after you get that HELOC, the rate's going to start to go downward. And now there's some opinions that differ from that. In fact, I read an article just 2 days ago where the New York Fed president said, hey, not so fast. We shouldn't lower the Fed funds rate at all until we get closer to 2% inflation rate. And of course, as we talked about earlier, we're still in the low 3s. So, but he's one opinion out of 19 total that make these decisions at the Fed. So not all of the Fed members agree with that comment. But the point is, I think there is going to be some reduction in the Fed funds rate this year. And if you get a HELOC, that's going to benefit you directly as it occurs.
Great stuff. Well, I'm going to turn it back over to you, and let's jump into last week's closing question.
Okay. All right. Thanks, Jeff. Okay, here's the question from last week. I'm looking to purchase a home and have student loans, but they're in deferment. Yet I've been told they'll still be considered in my debt-to-income ratio. Why is that? Very good question. We run into this a lot. When we pull a credit report, oftentimes it's getting to be less so now, but oftentimes we may see several student loans with some pretty hefty balances. In fact, I've had a couple of clients where their student loan debt was literally $250,000, $250,000. And there'll be a long list of those debts, all with zero payment being reported to the credit bureaus. But even in deferment, as we point out here on the slide, with a zero payment reported, student loans are often a significant debt obligation that in most cases has to be considered in your DTI, or debt to income ratio, and that's to comply with ATR rules, the ability to repay. Again, that was implemented back around 2010, 2011, where mortgage lenders have to take into account your ability to repay your mortgage based on calculating a debt ratio. So if there is no payment shown on the credit report, what payment do we use? Well, the first thing we tell borrowers is, if you can, provide us documentation as what the actual payment is that's being deferred. It's remarkable, though, how many borrowers have trouble doing that. The student loan administration and stuff, it's very interesting, because I find a lot of people just, even when they have all these loans, they have a hard time documenting what their payment will be once the deferment is over. So we find in a lot of cases that we aren't able to get that information. So as a consequence, what's the alternative? Well, then we have to use an assumed payment, and that will vary depending on the loan program that you're applying for. Fannie Mae, conforming, jumbo, and non-QM, that's non-qualified mortgage programs, they will generally use 1% of the loan balance. So again, if you've got a $10,000 student loan balance with zero payment reported, we're going to use 1% of that $10,000 balance, and that will be your assumed monthly payment to be included in your debt ratio. Now, other programs, Freddie Mac conforming and FHA, and actually I didn't put it on the slide, USDA, they're a little kinder and gentler. We only have to use half of 1% of the loan amount as your assumed payment. So a lot of times if we have a borrower who's getting a conforming loan, if we determine that using 1%, as Fannie Mae requires, is going to cause their debt ratio to go over the limit, then we will originate that loan as a Freddie Mac loan in order to use the lower 0.5% of the balance as the assumed payment to help them get under that debt to income ratio and be able to qualify. Now, with VA loans, it's even better in terms of the potential option of still not having to count a zero payment or in the debt ratio. And what I mean by that is with VA loans, if we can document that the deferment will occur beyond 12 months from the date the mortgage closes, then we can accept the zero payments on the student loans and not accept them in the debt to income ratio at all. So for those of you who are veterans and getting a mortgage and you do have student loans, keep that in mind. If you've got a lot of student loans and they're in deferment and they're going to be in deferment for more than 12 months from the projected date that you're going to close on a mortgage, you get the benefit of having those debts basically ignored in your debt ratio, and that's going to help you qualify for a higher loan amount. So very good question. Hope that helps clarify how student loans are treated in the mortgage underwriting and debt to income calculation process. And with that, let's go ahead and jump to our closing question for next week. Here it is. I'm self-employed and would like to buy a home, but I've been told my tax returns don't support getting a mortgage due to a high debt to income ratio. We run into this quite a bit. In fact, I've got a couple of transactions now where that's what we ran into. The question goes on with, instead, I've been advised to consider a bank statement program. Can you explain what that is and how they work? So again, very good question, something that we deal with quite a bit for self-employed borrowers. So tune in next week where I will have the answer to this and it will be on the house. Jeff, back to you.
Fantastic. Another great show, Art. I just want to jump in and kind of put a bow on our opening conversation of the time that you've been doing what you're doing. I often think about, and I hear this a lot in our education system right now, I'm not picking on, I'm just using it as an example, is what we learn in school. Let's say we go to college. 4 years, by the time we're done with 4 years, what we've learned is almost outdated, especially if you're in the tech field right now. And so, when you're out there getting information, do you want somebody who's in the trenches doing it all the time, like Art, or somebody who's philosophizing about what's going to happen? And I guess I would rather say, you know what, I want to know somebody who has a little dirt under the fingernails and they've got a little mud on their shoes because they're actually in the trenches making it happen. And they're dealing with the realities of today. And they're not just giving you this philosophy of what could, or a theory of what could happen. And I think that, Art, I think you are the guy in the trenches that I'd want in my, covering my backside when it comes to getting the loan. So thank you for all you do.
Oh, sure.
Hey, for those of you who watch the show and you want to say, hey, I want to get in touch with Art because, a HELOC is right for me. Instead of these high interest rate credit cards, you can get a hold of him at 760-883-5700. That's his office number, or his cell phone is 714-612-9035. And his website is mwloan.com. We encourage you to go there and check out the rates. He updates that as it occurs. And at the same time, there's a host of tools on there to help you figure out, something you said, Art, earlier about that 20% down. I couldn't get in the market. That whole segment was eye-opening because, I think, again, the news wants to make doing what we do, buying a home, almost impossible. And you showed right there, it's like 20% down and a $6,000 a month mortgage payment for a $950,000 loan. There's a lot of properties in the Coachella Valley that you can get into that I don't need a $950,000 loan. So I appreciate you taking the time to explain that. There's a calculator on the website that will help you determine, hey, what could I put down? It doesn't have to be 20%, as Art says. And check that out. And of course, you can always send Art an email at art@mwloan.com. Art, any closing thoughts before we wrap up today's show?
Well, a couple of things. You're right about being in the trenches. It's interesting when I started in the mortgage business and I was in the trenches and then I got promoted into upper management. I was kind of out of the trenches for about 6-7 years. And then going, after that company got sold, that's how we became mortgage brokers, which kind of put me back into the trenches. And, I think I'm more comfortable with that. I like to be in the trenches. It keeps you a little bit more attuned to what's going on in the industry. And most particular what's going on with borrowers and home buyers and homeowners and what their needs are and how you can fulfill them. So yeah, being in the trenches, I've found over the years has been a very valuable thing for me to be good at what I do. And the other thing I'll point out is, like you said in that segment about the high rent, but with people who have good incomes. I'm dealing with a case on that right now where the borrower, they make $150,000 a year. And I just the other day was in a position of telling them they were looking at buying a home up in the local mountains for a little under $400,000. I had to point out to them, if you wanted to, you could buy a home for double this price. But they were a good example of they didn't want to. Mm-hmm. So I think somehow that kind of spits out to being perceived as it's hard for people to buy homes. In some cases, this is more of a case of they can buy the home. There's other reasons that are causing them not to want to do it, and that's a different issue. So, and then the last thing I'll say is when we're done with the show, I'm going to go check to make sure my fingernails are clean.
I think it's important to have a little dirt under your nails. So when anybody says, "Hey, how'd that happen?" You said, "Because I'm in the trenches, baby. I'm in.
Well, yeah,
I'm covering
that's
your
good
backside." So,
okay.
Well,
right.
Art, thank
Fair
you so
enough.
much, and I'm going to sign off, and we'll see you next week on the Mortgage Minute.
Okay, thanks, Jeff. Thanks, everyone. Thanks for listening and watching. I'm Art Alvarez with Mortgage Works, where we do have the answers, and they're on the house. We will see you next week. So long. Take care.